Hey guys, it's Sasha. The stock market is not doing well. The Federal Reserve has suddenly realized that interest rates are going to have to go up faster than they previously said. China's COVID lockdowns are risking an unprecedented collapse of global supply chains, and Russia's sanctions are about to plunge Europe into an energy crisis. So it's no wonder investors are panicking. Tesla just posted stellar Q1 results, completely smashing all expectations, and their reward? The share price is exactly the same as it was before the results were announced. Any company that doesn't go and absolutely smash their quarterly results gets its share price smashed to pieces instead, as the stock market is panicking. So how bad is it? And how bad is the 2022 stock market crash going to get? Well, so far this year, the stock market has dropped about 12% as I'm recording this video since its peak on the opening trading day of the year on the 3rd of January. Fears of inflation and skyrocketing interest rates, global supply chain issues, and the Russian invasion of Ukraine in February have all contributed to a massive loss of confidence. Companies that are performing well and posting amazing results over the last 2 quarters have seen their share price absolutely decimated. So here is the state of play that you need to know about. First up, US inflation is spiraling out of control, and this was patently obvious for at least the last 6 to 7 months. And each month that the Fed does not act very rapidly, the problem becomes more acute. Because if they do nothing, there is a genuine risk of inflation running riot. However, Wall Street and seasoned economists at the Federal Reserve seem to be surprised that the inflation wage spiral is doing exactly the same thing it always does when inflation takes hold. For some completely incomprehensible reason, the public accepted theory that inflation will just go away all by itself is not materializing. In fact, it's only getting worse. As the war in Ukraine rages on, oil prices continue hovering around the $100 mark with very high daily volatility. And given oil was trading at around $63 in April last year and largely sat in the $70 to $80 range throughout the second half of 2021, the pressure on inflation from higher oil prices is looking likely to stay there for the next 3 quarters. Gas prices in April have gone bananas, and although they have come down somewhat from the crazy spike over the last few days, we are still sitting at an extremely high elevated level that we haven't seen since the financial crash in 2008. US rent prices remain high at 12 to 15%, and in the last few days, a lot of people have declared that the housing market bubble has finally burst, because the ridiculous growth in prices that we have seen in the last 2 years has now come down. The growth has stopped growing, and Zillow is now forecasting that the 12-month growth will only be at 14.9% in February 2023. Only 15% year-on-year growth in just under a year's time. Official CPI figures for shelter, remember, are currently at 5.0%, so we're still about 10% away from where the real figures are today, and when the CPI shelter data starts catching up, which eventually it has to, the impact on our overall inflation, including the core part of the index, is going to be ugly. In the March Federal Open Market Committee meeting, the prevailing message was that inflation has now peaked. That is what all the press wrote. This is it. It is now going to start coming down. No data or evidence whatsoever was provided for this, and I was sitting there scratching my head because it didn't seem to make any sense. It seemed like a political statement coming from a body that should have nothing to do with politics, trying to calm things down, and it's now extremely clear that the Fed was absolutely full of shit. Suddenly, key people across the US federal bank system have completely changed their tune. Loretta Mester, recently president of the Cleveland Fed, said that there is now not a pressing issue to go for a 75 basis point hike, and that a 50 basis point hike will be enough. Remember that this is barely a few weeks after the same people in the Fed were propagating the message that a few 25 basis point hikes for the rest of this year is all that's going to be required. Mester is now calling a 50 basis point hike the methodical rather than overly aggressive path, a very interesting and very rapid change in perspective. And on Thursday, Jerome Powell said, "It is now appropriate, in my view, to be moving a little more quickly," when he spoke on an IMF panel. I also think there is something to be said for front-end loading any accommodation one thinks is appropriate. I would say 50 basis points will be on the table for the May meeting, and naturally enough, analysts now place a 98% likelihood on the rate going up by 0.5% instead of 0.25% to a target rate of 75 to 100 basis points in total. The market did not like Jerome Powell saying the obvious and had a massive meltdown, selling off as soon as he spoke on Thursday. And we're now seeing the same exact pattern develop. The stock market seems to be living in a different reality to where I live, or maybe you live. A reality where inflation somehow doesn't exist. Only interest rates exist that are completely nothing to do with the world that we live in. Because you're wearing a blindfold, or maybe earmuffs, maybe both, to stop yourself noticing anything happening around you. Remember that the last meeting was held in mid-March, and the Fed meetings only happen about once every month and a half. So even a 50 basis point increase in rates next week is still far below the rate at which inflation is currently growing, because inflation went up 60 basis points in just March alone. And here is the problem. We are in for a few more shocking revelations throughout this year. Shocking revelations that a Federal Reserve rate of 0.75% is still lagging behind inflation, the official version of inflation, which is lower than what we know it to be in reality, by about 8%. This is unprecedented in the history of managing inflation. And by the time the Fed meets again in June, we will have had an update on April's inflation figures when we get to May, and then May's inflation figures actually come out the day before the two-day meeting starts in June. So we will have 2 months worth of extra inflation data before they have another opportunity to take any effect. And here's the really big problem if you actually zoom out further. China's zero COVID policy is absolutely decimating production and supply chains, far more than anyone is realizing at the moment from the analysts that are here talking about it. Shanghai has been on lockdown for a month. People are literally being physically locked up in their apartments. This is not an exaggeration. Entire streets are being blocked off so that you cannot physically leave. Everything in the city is shut down. A few factories, including Tesla's Giga Shanghai, have recently been allowed to reopen, but with massive production limitations and a significantly reduced workforce who have to literally live in the factory and are not allowed to leave for any reason. And this is while the supply chains to those factories are still in massive danger territory and getting absolutely hammered. And now this looks like it has spread to Beijing and other cities in China, where cases are now skyrocketing, and people who live in Chaoyang, the city's biggest district, now have to report for 3 coronavirus tests this week, roughly the same way that the massive shutdown in Shanghai started as well. The impact of China's way of dealing with COVID is going to be felt worldwide, and although the situation there has been going on for a month now, we still haven't really felt the full impact, much of an impact really, in Europe and the United States. Products manufactured in China take several weeks to reach our stores, so we're going to start really seeing and feeling those disruptions come through in the next month or two, and we're already hearing that supplies are very, very low. With the situation worsening and no end in sight, this isn't going to help Western economies when we see trading data come out in the coming weeks and months. And then there is Turkey, a country we all talked about a while ago when their inflation rate hit 20 to 30%, but Turkey seems to not now be a very interesting topic because there is more newsworthy items to talk about. But Turkey's inflation in March went up to 61%, up from 54% in February. And the rather interesting thing about the fact that Turkey is now sitting at 61% inflation rate is that they tried to cure that inflation before it got completely out of whack. And they tried to cure it by keeping interest rates low. In fact, in September 2018, Turkey increased their interest rates sharply to a record 24% level because inflation was risking getting out of control. And it worked. Then inflation that was very, very high at the time started to gradually come back down until it hit a rate of below 10% in September and October 2019. But although inflation was now at that point lower than it was at the peak, it was still high, and Turkey decided to go and drop their interest rates all the way back down before inflation was properly in check. And since inflation in Turkey went back up, Turkey did not go and increase their rates back at the same rate they did before. And now Turkey has one of the worst inflation problems in the world, and their economy is in tatters. So when you look at the biggest economies in the world, the US is at the start of the inflation wage spiral, but still largely keeping their head buried in the sand, pretending there isn't an issue to address. China's economy is stalling as the country is shutting down even more sharply than it did in 2020. Russia has committed economic harakiri by invading Ukraine and declaring themselves an international pariah state. Turkey's economy is in full self-destruct mode, Brazil's inflation is also beginning to spiral, and Germany and Italy are under huge pressure right now to stop using Russian oil and gas this year. And if they do go ahead and do that, their economies are going to take a giant hit as well. So if there's one thing we do know, it is that this year is likely to feel very painful for investors as the stock market keeps getting smashed by one thing after another. We are going to have some positive runs for sure at some points during the year because investors do tend to get excited. But we're also pretty certain to keep getting plenty of big smackdowns too. And it's becoming increasingly likely that this year will join 2008 and 2000 to 2022 as the year when the stock market drops by over 10% during the course of the year. It has already dropped over 10%, so it will hit that mark if it just stays flat or drops from here. Of course, anything could happen. We absolutely did not know half of what is happening right now at the beginning of January. So things could absolutely take a sharp turn for the better or get a whole lot worse. But the outlook for this year on average at the moment sure does not look very appetizing. So if you are investing in the stock market, this is a very good place to remember that the results we saw in the last 3 years do not happen every year. And for every good year, you have a bad year to go with it. If you're investing in companies, make sure that you invest for the right reasons, based on the company's fundamentals, based on your long-term outlook for that company. Do not make rash buying or selling decisions based on which way the wind blows today, because we're going to have plenty of very scary looking wins in the coming weeks and months. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it, and as always, I'll see you guys later.